Hello, my name is Joe Hoyle, and I'm speaking with you today for CPA Review for free. We want to help you get the points you need to pass the CPA exam. People just like you pass this exam every day. If they can do it, so can you. Let's do the work. Let's get those 75 points that you need to pass. We here at CPA Review for free are here to help you. Today I want to look at a question from the regulation portion of the CPA exam. More specifically, I want to work with you today on a question about partnership income taxes, a topic that can be quite difficult if you do not understand the rules. So what we want to do today is to help you start understanding the rules about partnership income taxes. As always in these videos, I want to start by reading the question. Please read it carefully and think about the information that's being given. The partnership of Shellstead and Evans had the following balances for its latest tax year. Revenues, $300,000, cost of goods sold, $200,000, rent expense, $20,000, charitable contributions, $10,000, and a guaranteed payments made to Evans for work done of $30,000. What will be the increase in Shellstead's adjusted gross income on his individual tax return? You've got the revenue, you've got the cost of goods sold, the rent expense, the charitable contribution, and the guaranteed payments to Evans of $30,000. But the question specifically asks about Shellstead's adjusted gross income. We have, as always, four possible answers. Answer A is $20,000. Answer B is $25,000. Answer C is $40,000. And answer D is $50,000. How will Shellstead's adjusted gross income on his own individual tax return be affected by this information? The first thing you need to know is that partnerships do not pay income taxes. They do file a return, but they do not pay income taxes. Instead, the various items pass through to the partner's individual tax returns. So if you have something on the partnership tax return, it is split between the partners, and that amount shows up in the partner's tax return. So what we need to know to answer this question is, how are these pass-through items handled? First of all, anything that passes through directly shows up on the tax return just as it was on the original partner's books. Any items that do not pass through are accumulated to come back to a single business income figure. So think about it this way. Some things pass through directly. Everything else is accumulated and then passed through as a single ordinary business income figure. So what we need to know is how these pass-through items will work. Normally what you should think about are the items that pass through separately. For example, capital gains and losses, they pass through individually. If it's a capital gain for the partnership, it's a capital gain for the partner. Dividend revenue, interest revenue. If it's dividend revenue or interest income for the partnership, it's also the same thing for the partners. And then charitable contributions. So that's important because we have one of those right there. That item will pass through directly. It will be a charitable contribution for the partnership. Therefore, it will also be a charitable contribution for the partners. And as you probably already know, charitable contributions show up as itemized deductions. So this $10,000 figure right here will not be part of the ordinary income, but will be an itemized deduction for each of the individual partners. Everything else that they have will be combined to determine what the ordinary business income is for that partnership. Before we move any further, I want to look at that guaranteed payment to Evans for work done. I did not mention that as a pass-through item like a charitable contribution. And the reason is it is not passed through separately. It is included as part of the ordinary business income of the partnership. So it will be handled just like any expense for the partnership. And Evans then will have to show this income on her own individual return. It's an expense for the partnership just like a normal expense would be, and it's an income for the partner just like any salary would be. It is not handled as a separate pass-through item. It's part of the ordinary business income that the partnership reports. So, what does that leave us as the ordinary business income for this partnership? Well, the revenue is part of that. It's not passed through as an individual item. The cost of goods sold is part of that. It's not passed through as an individual item. The rent expense is part of that. It is not passed through as an individual item. And then the guaranteed payment to Evans is just another salary expense. It's also included as part of the ordinary business income. The one item that is shown separately is going to be that charitable contribution. Everything else is part of ordinary business income. How much then is the ordinary business income? Well, we can do the math. Revenues of $300,000 minus cost of goods sold of $200,000 minus rent expense of $20,000 minus the guaranteed payment to the partner gives us an ordinary income of $50,000. Just to repeat, the charitable contribution is done separately. It is not part of the ordinary business income. In this problem, you have two equal partners. The ordinary income is $50,000. Each of these partners will report $25,000 on their income tax return from the business. Now, Evans will also show that salary is income, but the question here is specifically about Shellstead. The ordinary income is $50,000. Each partner reports $25,000. That gives us an answer of B. And remember, the charitable contribution passes through directly. So Evans and Shellstead will each get 50% of that $10,000, and it will show up not as an income item, but as an itemized deduction. They do get it, but it's not part of their income. It's part of their itemized deductions. And the question was asking specifically about adjusted gross income. Okay, this question's not easy. I understand that. You've got to realize that the charitable contribution is pulled out and shown separately, but the guaranteed payment is not. It's part of ordinary income. It's not easy, but the rules are clear. And once you see how to get this question, you should be able to get it the next time. That's the goal. I don't care if you miss it today, but I want you to get it right the next time you see it, because the next time you see it will probably be on the CPA exam. This will add a point. This is part of the regulation, part of the exam that they expect you to know. Can you work the question now? If the answer is yes, that's perfect. If it's not, watch the video again. You can learn this stuff. You can pass the CPA exam.